Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number over here at the radio station. Give us a call, and we can help you answer problems that you might have thinking about your mortgage, about buying a new house, selling a new house. The market has really changed in the last 6 months, as I'm sure everybody realizes. Right now, we have more inventory on the market than we have had in a number of months, if not a year or two. Reason for that being is that we have rising interest rates. We have less ability to be able to get new home buyers into the market. Millennials seem to be resisting, although millennials are the largest buying group in history. And I saw a statistic the other day that showed exactly the difference between baby boomers, who used to be the largest group, and now the millennials, and that's from 1985 to 1999, is that particular age group. This particular group obviously are getting into the years that their income is increasing, also their desire to form households, and that usually means getting married, perhaps having children, although the non-traditional household has taken a footing here in the U.S., as well as a lot of Europe and other countries around the world. There is still a great deal of resistance in certain corners of the world to that particular phrase. However, these are realities of the times we live in. I know that we have spent some time trying to deal with that, both educational-wise as well as legislative-wise, in terms of trying to make sure that borrowers get the full benefit of being obviously an American citizen, somebody who has all the rights inherent within and built into the legislation in Dodd-Frank, as well as the CFPB regulations and the new TRID regulations, as well as what's coming out in January of this year for HMDA, HMDA. Now, most people don't know what the heck that is, but if you have recently filled out an application for a loan, there is a section that calls for you to identify yourself, and if you don't do it, the loan officer is going to do it. So as I instruct my loan officers to make the best guess, it's actually better for you as the borrower. Now, why do I say that? Because when we're doing loans for people, the government, the CFPB, the powers that be, HMDA is demographic information about who you are and the type of ethnicity you are and the type of background you have, family, where you're from, that kind of stuff. Because lending tends to be local, even though these laws are federal. So if you're in a certain area let's say you're in San Bernardino, Riverside, and there are a lot of different areas in those terrific areas. And by the way, hi to everybody at KCAA and KMET, the great people that put the show on for us out there in the Inland Empire, as well as K-Tahoe and those terrific folks up there in the Tahoe area. But in those areas that maybe, it's harder to get a loan than in certain other areas. Now, it's supposed to be non-redlining, and that's what the HMDA demographic is supposed to give. Additional information beyond just the standard, what's your name and where you live. They want to know your ethnic makeup, your background, some of the other questions in there. And the reason they do this is because they want to try to eliminate redlining. And if it's local in an area where you're now sitting and you're saying, well, you know what? My friend, who is exactly like me down a mile or two from where I live, is getting a loan, whereas I think I'm exactly like him as a borrower. I can't get a loan. It's possible, it's not necessarily proven, but it is possible that in that particular area there is redlining. And what is redlining? It means that the lender draws a red line around where you are, and anything inside that red line does not get a loan unless they meet a certain criteria, which is different than the person who lives in a different area, down the street, down 2 or 3 miles away, and that's usually because of either the area that the person lives in or the demographic makeup of that particular person, whether it's a minority, whether it's in a poor section of town, whether it's a particular religious significant person in terms of identifying why the lender is not. Anyway, that's why they're doing all this HMDA stuff. And the information on those particular forms helps the CFPB and also anybody that looks at it from a regulatory standpoint to determine if lenders are avoiding certain areas or charging higher rates. You know, all right, sir, we can get you a loan, but we're going to have to charge you a quarter point higher because, well, they're not going to say this, but that's what the CFPB is looking for. They want to see if, in fact, there is charged a higher rate because you live in a certain area, or because you're a certain ethnic makeup, or because you have a demographic makeup which puts you in poorer sections of town. This has always been thought of as what has been happening in the lending industry. Now, let's talk the flip side. Most people I know would prefer that their information about who they are, what they are, remains with them, without being information that can be used in any regard, whether it's to help them get a loan. Most people view government getting into their lives as something that's a negative. Let's face it, do you want the government investigating how much money you really made on your taxes? Heck no. Do you want the government deciding for you whether the interest rate on your loan is too high or too little? Probably not, because they're also going to want to investigate not only your taxes, but your status as a citizen, a lot of other things that you possibly want to keep private. So there's this need by the government to try to get as much information as possible. And then there is also the desire by citizens not to necessarily tell the government anything about who they are beyond what's needed in the loan application in order to get the loan. So this area of the HMDA regulation, which comes into effect, by the way, in the first of the year. It's been in voluntary status for about a year, and they were trying to tweak it, trying to change it a little bit in order to get people comfortable with it, or at least vested in it a little bit more. However, if the actual borrower does not want to be able to put down this information, let's say that, you ask the borrower, okay, what's your ethnicity? And you give them a list of the things that are their choices, and they say, I don't want to give this information. Or they ask any other of the several questions that are on this particular end of the loan application, and they don't want to participate, which they don't have to. It's not legally binding. However, it is legally the obligation of the loan officer to do this if you don't do it. Now, why is that significant? As I tell my loan officers, look, you got to make a guess. You got to make a guess. But doesn't this put the loan officer in the position of trying to tell whether somebody is a certain ethnicity or a certain background or a certain, income qualifications by a guess? I think it does. I think it actually, if you have a number of loan officers at one company who are guessing, yet the other loan officers are actually able to get their clients to be able to tell them the information, let's say that the guesses are wrong. And let's say that that puts that particular lender under the microscope because the loan officers have guessed wrong that certain percentages of ethnic minorities are getting higher rates, when really the reality is that it's not necessarily so, because the loan officer guessed wrong on the demographic information of the borrower. I just think any time you're asking someone to guess about somebody else, you're putting people in the position that they have to make decisions, and quite normally, decisions that are made in the blind are absolutely wrong. Imagine trying to make a decision on rate when you didn't know any of the competition out there in the marketplace. You're just given a sheet of paper and say, choose something that you can afford. How do you know unless you have all the comparative information out there, other banks, other lenders, talking to several different people? You have to understand exactly what you're doing in order to make the best decisions possible. Anyway, I'm Jeff Barton. I'm your host, And I really appreciate you listening to The Mortgage Voice each and every week. We've developed quite a good audience, and we'll be right back. I appreciate you listening. Again, I'm Jeff Barton for The Mortgage Voice.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's a telephone number. If you pick up the phone and give us a call, we can try to help you figure out what you're doing when you're buying that house, or you want to sell a house perhaps and buy something else. Maybe you have to take some money out. There's all kinds of needs that you're going to have in mortgage industry. Questions, rates, costs, what's happening in the market. Do I have to do something right now? If I'm not a non-traditional buyer or borrower, can I get a loan? All these questions we try to answer on the show, and bringing guests to you who can do that. We try to do that each and every week. One of the guys that's a terrific loan officer, great employee of Malibu Funding, Inc., is George Gonzalez, who is out in the Rancho Cucamonga area. George, how you doing?
Hey, I'm doing great out here, Jeff. The weather's beautiful. I feel like actually I'm in Malibu.
That's very funny. And for those of you who don't know, I live in Malibu, and George is always nice enough to bring that up on the show. Hey, listen, before we get going, as we were talking off air, I'm sorry about the Dodgers. We were all very sad to see that series happen the way it did. I know you're a huge fan, and for those that don't know, George is always on Facebook and promoting his, both his family, his business, but at Dodger Stadium. You're going to miss that a little bit, right?
Oh yeah, well, it goes with it. You got to take the good with the bad, and honestly, Boston with 108 wins, and they ran over the Yankees, they ran over the Astros. There was no tomorrow. At least we were there with them, and there, we had a shot. There was a couple. Obviously, the whole world knows where the bad call was by the manager by pulling out Rich Hill in the 7th after.
Yeah, I don't know why he did that.
Excellent job.
Yeah.
I mean, we can ask even President Trump, what's going on with this guy.
Yeah, it's funny. With all going on in the world, the president decided to weigh in on the managerial decisions of the Dodgers. It's funny, I think, He gets involved. Okay, so tell us a little bit about what's happening out in Rancho in the mortgage world, and what's happening in the real estate world.
Well, right now we're noticing, a little what they call a setback on prices. I'm noticing my offers are getting accepted a bit quicker.
Right.
I got a lot of escrows we just opened up in this last 30 days that their purchases, like I said, their offers they want to see a qualified buyer, and by the time when they see that this buyer is qualified, they're taking the offer trying to get this house sold. So, they're tired. A lot of houses are sitting right now 60, 75 days on the market by getting 3 or 4 offers versus 6 months ago where there was 10 offers in the first week.
Yeah, and why is that? Do you think it's because there's a little bit of tiredness? Maybe the market is a little slowed down because of the time of year? How do you figure that?
To me, because we're in the mortgage business, it has to do with the mortgage. A little spike rate, the rate spikes that's been happening.
Yep.
A little bit here and there. People too many times think of the rate. It's not the rate; it's the payment that really matters. Because,
right.
An eighth or a quarter is not going to kill you. It's $20, $30.
Right.
One coffee a week less. A month, and you have to just explain that to the client to let them understand that. Look, it's not going to affect you that much. You don't have $1 million unless you do have $1 million loan or higher. Then we might talk about a little difference. But
sure,
under that, it's really not that much of an effect.
Now, do you find that most of your clients are into the Fannie Mae, Freddie Mac box, conventional type loans, FHA, or is it more of a non-QM product that you're selling?
50-50 right now,
okay.
Switching. And especially for the investments, there's some new deals that have been coming out where there's no employment, no income on the 1003, as long as they have reserves and at least 20 to 30% equity in the property.
Wow.
They're allowing a normal Joe Smith to pull cash out up to 70 or 80% on their investment property if they have one, without having to prove employment or no income.
Now, how does that work with the ability to repay, or is this some kind of a commercial loan where all they're really interested in is, does the building actually carry?
That exactly. exactly what you just said.
Right.
The lease has to be, obviously they're going to do a rent survey to make sure you're giving an accurate rental number, but it just has to be $1 over what the payment is.
I see. Well, that's a pretty good loan. And when did these come out? I actually heard a loan the other day that was very similar to that. I think it was like 20 to 25% in the property, but they didn't. The only thing they cared about was the equity in the property. That's all they cared about.
Well, and here I forgot to mention a good part about this new program by one of our approved banks is that they're giving 30-year fixed at a 6% rate, which
that's outstanding.
Oh, dude. I know.
6%, 30-year fixed. That's outstanding on this kind of a loan.
With no income.
Right. And that's because why? That we have an ascending real estate market, and because there's so much equity into it, the actual lenders feel safe with this type of loan.
That is correct. They know that we're not going down the market. We might be leveling a little bit, but we're not going down. And investors, if they need some cash to fix up their investment property or whatnot. I mean, and it actually is a safer one than these other ones out here. I just closed, I think, one a few weeks ago or a month or so ago where we had to give the hard money 11%. The guy needed an 11% and for the same type of loan. And it's not a 30 years. It's amortized over 30, but it's due in 2 or 3 at the most.
That's right. No, I think anytime you can get a long-term loan, well, the hard money, that's expensive. But these are kind of like hard money. You just have to have a lot of skin in the game. Obviously. Well,
we're at 5 on the conventional side. Your best deal right now, on an investment, we're at 5.625, 5.75 on it.
So what's the difference? I mean, it's like you were saying earlier, a quarter point's not going to mean that much difference on a conforming type loan if it's one of these investment properties that you have 20% in. I mean, what's the difference in the payment? $20-$30
for the hassle?
Yeah, come on. That's what I'm saying. I mean, this type of loan. I think it's such a great deal, 6%. Hey, we're going to see 6% in mortgage rates a year from now.
Exactly.
I mean, I don't know if you think this, but I believe that we'll probably see one more rate hike before the end of the year.
Yeah, that's what they're talking about. Yeah, and that's what they're talking about. And you know what? We can afford it because, there's, like I said, there's people now. And hardly anybody's unemployed these days.
Right.
Everybody's working.
Right.
So multiple incomes in the household. They have the non-occupant co-borrowers.
Yep.
You don't even got to live in the house. I can just say, hey, I'm going to help my little cousin qualify. Just go ahead and put me on the loan, but I'm not going to live there. They're fine with it. So, that's what's helping people stay alive to buy their house right now.
Do you see multiple borrowers on applications for properties?
Oh, yes.
Right.
Oh, yeah. My more expensive ones, the ones that are over $500,000 or, over the conforming like $400,000 and up. I'm seeing you needing three or four people out there, and especially out there in LA County.
Right, and due to the fact that we have a difference in the mortgage deduction on the interest payment, do you see that deterring anybody, or is anybody even looking at that as a problem?
Yeah, you have both. You have the ones that say, I don't care what that looks like, I'm going to go forward.
Right.
And then you have other ones that say, the sky's falling, let me put it on hold. And, there's people I've been chasing around for 2 years, and I still can't get them. But, I'm going to still keep chasing until they tell me to stop.
Right. No, absolutely. Absolutely. Okay, so we've talked a little bit about mortgages, programs. What do you consider to be the real estate outlook for your area? Do you think that the property values are eventually going to get to whereby you'll have an even number of buyers and an even number of sellers?
Yeah, that's what we're turning. As you said, that we're turning into a buyer's market. Mm-hmm. As I mentioned, I have a few strong realtors right now who get many leads, and as soon as we qualify, I'm offer accepted. I'm like, wait a minute, let me finish my due diligence,
right?
and get their stuff going. But yeah, that's what I'm noticing. I don't know if you noticed because I worked with you for so long, but
right.
Usually the end of the year is my busiest, is where I gain most of my ground is these last 3 months.
Well, so many people say, oh, it's the holidays, I don't want to work. But I know there's a lot of people out there who both need loans, refinances, and also are trying to purchase because they too see that the market is softening a little bit, maybe get a better deal than you did in June or July.
And that's their Christmas gift to their family or
right.
whatnot. And, so, That's exactly how it is right now.
Okay, and the refi market, that's pretty much over, right?
I thought so, but no, because right now, again, there's equity. A lot of people have accrued a lot of debt, and the debt's weighing on them. They need to help their kids buy.
Oh, yeah.
They do this and that. So I'm noticing, I got repeat business, thank God.
Okay.
And they always call me and say, George, I know you got me a good rate last time, and the rate's higher this time, but I really need the cash. And so I'm like, okay, well, let's do it.
George, thank you very much for coming back on the show, giving us an update on what's happening in the Inland Empire. Appreciate it.
Hey, no problem, Jeff. Thanks for having me anytime.
Thank you very much. That's George Gonzalez from Malibu Funding, and I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can help you. And one of the things that we're going to help you with is my next guest. I'm going to introduce her quickly because she's in line to help pick them up from school, all her kids. Cammie Rhodes from Premier Financial. Cammie, how are you today?
Hey, good. How are you doing?
I'm just fine. Thank you very much. And thank you very much for sending out that flyer on some of the programs that you're boasting from your company. If you can just give us a brief description of what they are. The flyer that talked about your private money, your commercial loans, the fix and flips, the investor advantage, those kind of things.
Absolutely. My favorite program right now is our Fix and Flip program for professional flippers. So if you've had at least 2 or 3 successful exits in the last year, successful flips, we can lend 80 to 90% of the purchase price and 100% of the construction at about 8.5% interest, which is a tremendous deal for private money. An interest-only loan. It's intended for short term so that they can rehab or do whatever construction they need to do.
How long is the term, Cammie?
It can be 1 to 2 years.
Okay, that's good.
But, ideally, if you're flipping, you want to flip quickly if you can.
Of course, you want to get it done in 90 days, but most of them are at least about 6 months before the money's due. With this 1 to 2 years, that's a good deal.
That's right. And also, you never know when you unpeel the onion and when you start digging what you're going to find. So sometimes you need a little extra time to deal with those issues.
Right. And in terms of this fix or flip, the pedigree that you have, how do you go about proving that to you guys?
So they ask you for a list of your REOs that you sold. We check the addresses, and we can see, we just do our due diligence and we check it out. And you can usually tell, too, if somebody has experience or not.
Of course.
So, it's not a lot of paperwork because it's really very much based on the person's experience and the value of the real estate. So that's the collateral there, which is why it's so much simpler. There isn't this tremendous underwriting period. I've closed in as quickly as 4 days.
Wow.
People don't want to use their own money to flip. They want to invest their money. They don't want to tie it up.
Well, now, how does that work? Do you release the money right away, the fix-up cost, or do you wait for inspection? How does it work in terms of getting the actual fix-up costs?
So there's 2 ways to go. If we do a proper construction loan, it's obviously going to be dispersed, but our disbursements, usually when you deal with disbursements, it takes like 3 weeks or a month in between, and they've got to come out and inspect it. That's not the case. We just need to see the receipt, come out, see the work is done, boom, you have your next disbursement. It is not a lengthy process, talking about 24 to 48 hours to get a disbursement. And if they have other properties they can cross-collateralize and they just want to pull all the cash out, then they have control of their cash and their funds. So, in other words, I have one person who's such a heavy hitter that I just did a line of credit for them for $5 million so that they don't have to do individual loans because they do so many flips. They just want the money revolving. So that's what I did for them. So I try to customize it. I always say, if you don't fit inside the box, I will custom build the box around you. Nobody fits in a box. Otherwise, you're square.
Hey, Cammie, could you shout out your phone number for people to understand how to get in touch with you? This is a great program, and I think the money's cheap. And, if you could do that, it'd be great.
You bet. Thanks, Jeff. It's 818-370-9301. Again, that's 818-370-9301, Cammie Rhodes.
And we've been talking to Cammie Rhodes from Premier Financial about a great program for fixers and flippers, especially for those out there who have done this before, veterans in the business who know the value of cheap money gotten quickly. Obviously, we're in a market right now where we're seeing a bit of flattening of prices, not necessarily a decline, but certainly the acceleration that we've experienced over the past 18 months to 2 years has really slowed down. How's that going to affect your decision making in terms of giving out these kind of loans?
It all, is the main thing that our investors are concerned with is that in worst case scenario, if somebody is not able to make their payments, that they are able to recoup their losses by selling the property. And I've never had that have to happen.
Right.
Thank goodness. All of my borrowers have been lucky enough, knock wood, that they're performing loans and the investor's happy and the borrower's happy. But it's really all about the property. As long as the property is going to hold its value, we're good to go.
Okay, that's excellent news. Now, prognostications about what's going on in the business. Where do you see us, both as a real estate availability and also on rate? I know you guys aren't necessarily rate conscious, but as the rates go conventional, so do yours. Where do you see us in about 5 to 6 months?
Well, the truth of the matter is they don't directly affect our private money department.
Right.
And that's because, it's different when you're dealing with the residential market. When you're talking about people's homes, the commercial market is really a different beast. And it's not that it doesn't get affected when there's something drastic like a recession, but it really falls under a different category. We're dealing with, commercial and businesses. And the truth of the matter is a business person doesn't move forward if it's not going to be a strong situation.
If they're not going to make money, they don't want to do it. Sure.
Better. They know better, whereas the average person, they need shelter no matter what, So it is what it is. So it doesn't necessarily affect us directly as far as private money goes. In fact, over the last few years, I watched private money get more and more reasonable because you've got savvy buyers and people who now that flipping's become so big, people have their own money to flip with. They don't really need you as much as they've done a few. So you need to be a little more competitive and creative and to get it done. So, it used to be that if you were going for private money, you're looking at least 10, 11%. Now they're doing it at 7.95, 8.5%. And it used to be it was only referred to as hard money. And it was 4 or 5 points, and it was for people who didn't have credit. That's not what this is. This is for people with good credit, who have money, who just don't want to part with their own money. They don't want to invest their own money. They're making, you hear the commercials.
No, of course.
Money, thousands of other people's money.
No, absolutely. I think what's happening here in the marketplace is that as we've seen conventional money and Fannie and Freddie money and the rates rise and be more expensive, we've actually seen the reverse in private money, whereby...
That's exactly it.
And to me, I think it's because there's competition in the marketplace, because obviously if you have 2.5-3% in private money competition, everyone's going to want to try to fit themselves into the Fannie and Freddie box. But as that money becomes more and more expensive, it becomes obviously a better deal to go with a private money, which is easier to get. It's the terms may be a little bit harder. It may be a little bit more expensive, but you can actually get to the money quicker, and that's why, because the money's actually cheaper as the money for Freddie and Fannie goes higher. I just think it's interesting.
It's exactly right. And not only that, but a few years ago, if somebody had called me and said, "Can you do raw land?" I would have said, "Nope."
Right.
If somebody said, "Oh, we have a program that's 80% purchase, 100% of construction," I would have laughed and said, and how much is that? And that's real now. That's real now, and it's affordable now.
I know land money. What are you
Yeah,
guys?
the
What are you
land
guys lending on money on land? 50%?
I'm doing a deal right now in Hidden Hill, 50 to 60% LTV at 9.5%, and it is just a patch of land. There's nothing else.
Wow, that's real. And what are the terms? 2 years? 3 years?
I've got one investor who wants to do one, and the other one who wants to do two. So it depends on what's more comfy for the borrower.
Right.
You know, what they prefer. That's what I'm here to do is, you know, make their dream come true and help them realize their project. And people are just getting a lot more, you know, I used to see so many files that were not as strong because everybody was only, you know, just recovering from the recession.
Right.
And it's like you said, it's so competitive now that it's moving in the other direction. So, which is really good for me because the borrowers have, you know, more qualified files.
Right.
And I'm able to give them more, which makes them happy.
Hey, Cammie, we've run out of time.
Okay.
So we made it under the wire. We beat the kids. Good job. Thank you very much for coming on the show.
They're actually in the car. I've got great kids.
Good job, children. Thank you very much. And I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back. Bye, Cammie.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can help you in your decisions of what to buy and how much you're going to pay for it and if you can afford it. These are 3 questions you have to ask anytime you want to buy something. Okay, where is it, what is it, and can I afford it? We will try to help you do that. And if I can't do it, I certainly have 40, 50 people I know in the industry, as well as it works for Malibu Funding, the sponsor of the show, to be able to help you get through that. In certain areas of the country, I am not the expert, so I always call on people who are the expert. And one of the people that I do call on and has been very helpful for me both here on the radio as well as in person and on the television show we do out in Las Vegas, Nevada, is Jean-T Chun, who is a real estate agent for the Realty One Group. Jean-T, how are you?
I'm good, Jeff. How are you?
Me? I'm doing very well. Thank you very much. And thanks for coming on the show. I know we were just talking off air about some of the opportunities that exist in Las Vegas, and you were saying to me that it is not a great time to open a business there. Give us a reason.
Well, you know, I only have my one business, which is my gelato store, and I have been trying to find another location to open.
Right.
And for me, for my store, it has to be someplace that, you know, brings in a lot of crowd, you know, that has a lot of foot traffic.
Right.
So I need to find the spots that, you know, has a lot of influx of usually people are visiting, you know, not locals. Locals don't really want to pay. I mean, it is a little expensive for gelato, I suppose.
Of course.
It comes from Paris.
Right. Well, you know what? Name brand. And so you need to be in a high-traffic area where people are tourists that'll spend the money because they're on vacation.
Absolutely. So it's you know, I mean, they are building quite a bit of commercial space still, but the spots that are in the high-traffic area spots, you know, like Fremont Street or the Strip or something like that, it's outrageous.
Right, outrageous.
I mean, outrageous, you know, up to $4 or $5 per square foot.
Yeah, that's basically as high as it gets almost in any metropolitan city. That's a big number, $4 or $5 a square foot.
Well, absolutely, especially here in Las Vegas, you know. So so I get it. So it's been tougher as far as the business owner to find reasonable areas, basically, or a good area, for reasonable price.
Okay, tell me a little bit about what's going on in the real estate world. I know that yesterday you gave us a couple of updates on what's going on, and we were talking about, you know, if you go online or if you research it, the information that's out there is conflicting. Tell us about that.
It is conflicting, and you know, depending on what you read and where you read it, it has been quite tough for me. I mean, I was just doing the research yesterday, you know, for the stats basically, and I was getting all sorts of different numbers, and so I would have to check to see when it was written, and some were just written this year, so it's a difference of maybe a month or two possibly.
Right.
But it was kind of all over the place. So what I'm seeing personally as a real estate agent here in Las Vegas. as far as the market goes. You know, I mean, it's starting to level out a little bit as far as the prices. Now, we still have a very low inventory. You know, we don't have a lot. I think right now, as far as listing goes, you know, there's 4,000 or 5,000, 6,000, you know.
Right. What's typical? 10, 12,000, 14,000, 7,000?
Well, a typical market would, 12,000 isn't even that much if you think about it.
Okay.
I mean, not much at all. You know, the stable market is you need like, about 4 to 6 months supply, right?
Okay, that's true.
We're still at the, 1.5 roughly supply.
I see, okay.
Now, prices, you know, have been going up the last few years, but what we're seeing now, but of course it's the holidays. So it's going to be a slight slump because of the holidays. But we're starting to see certain places level out, certain areas. Now, certain areas, though, are still increasing quite significantly, too.
Give us your idea of what is an area where there's still opportunity to get in for, I don't know, a couple 100,000.
Oh, my, a couple 100,000. That's going to be tough. You're going to have to go maybe east or north Las Vegas. And, now...
Right, that's north of the 95, right? And let's say east of the 15 in that section of North Las Vegas?
North of 95 and, either west or east, you know.
I see.
All north, west or east. And then you go to the east side, which is east of 95. Yeah, that's east of 95. So, but even those areas, because there's no supply, you know, you're looking at over 200,000. You know, it's going to be very, very rare to find something under 200,000 now.
It is rare.
Yeah, below the 200,000 range, though, a lot of people are starting to buy condos and townhomes now.
Right, exactly. Actually, I looked for a condo or a townhome because we spend office money out there, and I'm thinking, why am I spending office money? I know that the city or the state will allow me to run my business out of my home, so I could say I live there and I'll buy a condo cheap. There is no cheap condo anymore. I looked. It's impossible to find.
No, Vegas was one of the more affordable, you
know,
for all of it, but now that's starting to not be the case as well. At 170 median price range for condo and townhomes, that's still fairly high. And you're looking at HOA of 150 up to 350 for these condos and townhomes. So that doesn't work out sometimes. Now, as an investor, that won't work out for me. I don't buy any townhomes or condos right now.
Why is that? It's just you're never going to see the return?
Well, yeah. I mean, as an investor personally, I do flipping, so I don't like to hang on to the property too long. Now, I do have some rentals that I've had, but I bought these rentals back when it was $40,000-$50,000.
Oh, well, that's a different story right now. Not only are you sailing pretty because the income, I mean, not the income, but the worth of the property is so much more, but you're probably getting pretty good rent too.
Yeah, exactly. Because the rental, the rental stats are a little bit high too. For an average, it's like $1,400.
Oh, that's
a month,
good.
Basically, yeah. Here in Las Vegas, it's kind of climbing too. So even in the east side, if you're looking at a rental like a 2 or 3 bedroom, that's gonna minimum $900, $900 to $1,100.
Right, and I think with our audience out here in the San Bernardino and Riverside areas, I mean, they're hearing that and going, "Wow, that's cheap." But for Las Vegas, that's not cheap. Traditionally, it's been a lot cheaper.
Because, I mean, the same house or the same place, that the 2 or 3 bedroom, a couple of years ago was only $600 or $700 per month. That's rental-wise.
What's happening to these renters? Are they just having to work more or bring in more people to pay the rent? How are they affording it?
Yeah, I mean, one place can have 3 or 4 roommates.
Right.
You know, it's starting to be, like California or New York almost.
No, that's right, where you have to bring in a whole bunch of people in order to get the rent paid. No, I understand that.
Yeah, exactly. And, I mean, our wage here isn't as high as some of the country, most of the country anyway, so.
What is the minimum wage out there? $10 an hour? Less? More?
No, I think is it 8 something?
Oh, it's 8, I see.
No. Honestly, I don't know.
Well, what do you pay your employees?
Well, I don't do the payroll, unfortunately.
Oh, I see. Well, good for you. I would claim ignorance as well. I don't know what I pay my people either, so that's a good point.
No, I really don't. Now after this, though, I'm going to go find out. I know.
That's funny. Okay, very good. So, all right. So the real estate market, what we've got is a flattening in prices, but the median home price out there is how much?
The what? I'm sorry, the median price right now?
Yeah, the median price.
For single family is about $315.
That's a lot. I mean, you look 4 or 5 years ago, it was like half that amount.
Yeah, absolutely.
It's really tremendous. Do you see the growth continuing to happen? I understand that the growth was, about 15, 16% last year, but it's not quite that this year.
No, I think we're looking at maybe about 13%.
Oh, I see. That's not bad.
Relatively, it's been about 13 to 20% each year. Now you have to consider the areas.
What do you mean? Some areas are rising faster than others?
Absolutely. Well, no, some areas, depending on, I guess, how many is for sale, the competition, how many inventory is there.
Mm-hmm.
If you look at a graph, basically, of all of Las Vegas as far as increase and decrease, every single year is slightly, the numbers are a little bit different, so they just get a range, right? So the range is about 13, 15%. But some places have like 20% increase, other places, decrease by, a couple percentage. So it just depends.
Okay. Hey, thanks very much, Shanti, for coming on the show once again and sharing us your information about what's going on in Las Vegas. Thanks a lot.
Absolutely. Thank you for having me on the show again.
You're welcome, and we'll do it again. I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929 is the telephone number. NMLS number 79620 from our sponsor at Malibu Funding. Thanks to those folks for putting the show on for us each and every week. We also have an email address, info@malibufunding.net. And you can email us questions. I know the telephone number, a lot of people write it down and call later after the show is aired in order to figure out exactly what's going on with their mortgage. They get time to put together questions in their head. So that's a good thing to do if you want to do that. Just write down the 888-713-2929 telephone number and give us a call later when you've formulated the questions. There's a lot of information that we throw at you on the show from different angles concerning the mortgage, whether it be, the individual rates, the programs. The guests we bring on the show are absolutely terrific, and they do it for nothing. So if you do have a desire to talk to one of these people, again, you can call me, ask me their telephone numbers. I'll be glad to give it. You can go on YouTube, by the way, where this show is being shot and aired, and the telephone numbers of the people that we're speaking to, the guests on the show, appear right next to the picture of that person as it is on YouTube. If you go to YouTube, the channel is Jeff Barton, R.E. What is it, Daryl? What is the real estate?
The Real Estate Voice.
The Real Estate Voice. Excellent. Thank you very much. And that's where you can find the information about the guests, the show, and you can see it at your leisure and come up with different questions. You can always get in touch with us. Let's see. We have a Twitter at Jeff6493. We have a blog, bartonblog.net, which we have really got to get better acquainted with. I'm on LinkedIn, of course, Facebook, and a number of other ways that you can get in touch with us for the company, for the show, and any other thing that might be helpful. We do a television show out in Las Vegas, the Las Vegas Real Estate Show, and we shoot that each and every week, and it airs on Sunday at 4:30. So if you're in Las Vegas and you want to see what we do out there in terms of real estate, it's kind of very similar to what we do here. We talk about real estate, we talk about mortgages, we give you advice, information, we talk to people that also are in the business, try to give you a perspective from their standpoint as to what's going on with the market and the real estate world, as well as mortgage rates and programs and such. A couple of things. I ran across this article, a guy named Deal, Diehl, and I believe he's got a mortgage letter. But it was very interesting because we've been talking about fraud on the show, and my company that I work for got hit with some fraud, and there's been fraud out there in the marketplace forever. However, there's a new twist now that we've got, the internet to the degree that we have. Most everybody that is under 40 years old, they live on the internet. Myself, I'm in the 60s, so I can attest to the fact that I spend too much time on the internet. But this guy's information is really spectacular when it comes to what's going on with fraud and how exactly it's being used with, obviously, the information online. Mortgage fraud seemed to have declined after the crash. New types of fraud emerged with a number of properties that returned to the market and many types of servicing-related fraud. Fannie Mae recently released information about fake employers, and we talked about this on the show before, that were being used in transactions. Even crazier, and I think I alluded to this, but I actually have the websites available. The FTC released info this week about sellers of fake documents using sites like FakePayStubOnline.com and iVerifyMe.com. The FTC claims that such quality, authentic, fake forms proven to work. I mean, think about this for a second. This is out-and-out mortgage fraud, fraud against lenders, fraud against anybody who's legitimately trying to get a loan. And think about this. If this is as large as we think it might be here in Southern California, although this article dates back to September, and I think the problem actually arose or came up during the course of May and June. So this is going back a few months. Anyway, this mortgage fraud being online, if you're competing with people for the money that's in the mortgage pool, and a certain percentage of these people are obviously getting mortgages, it's kind of taken away from those people who can legitimately get a loan. So if you haven't been able to get a loan because either the rates were too high or the competition for the money of that particular lender made it so that just wasn't funds available, this is one of the reasons why. But having it so blatantly online, I mean, fraud.com, I mean, think about it for a second. This is just absolutely ridiculous when you're talking about how am I supposed to get a mortgage? Well, this is not the way, but apparently somebody's making money on this thing. I don't know what the rates they charge. I didn't really go to the sites themselves, but I thought it was interesting that I'd bring it to you just because so that you realize that there are still people out there who want to commit fraud, who want to do things, and because it's now made so easy, I mean, how are you supposed to track down the owner of the site? I mean, I guess the FBI would be involved with this. How are you supposed to track down the people involved with it? How are you supposed to figure out whether, the mortgage professional was involved or the borrower is involved or whether some third-party person is providing documents? I don't know. It's all, to me, just amazing. And again, it's because it's online, it's easy to get, and it's very difficult to trace. Also, Fannie and Freddie, now about 2 years ago, we started to talk about the private market in the back end of the mortgage. What we needed to do was to get a private market starting to compete with Freddie Mac and Fannie Mae. And those are the two largest. I mean, they were buying 90% of the mortgages out there in the marketplace 2 years ago. Well, since I guess about 6 months to a year ago, we've started to see a private market develop, i.e. the non-QM loans. Obviously, if you're out there right now and you're thinking, what the heck is a non-QM loan? These are non-TRID related loans, or some could be TRID related, meaning that if you have the Truth in Lending Act and the paperwork associated with those old documents, TRID is now part of the ability to repay your particular loan. What we're trying to do is to say, look, the way it used to be is that everything had to conform to a certain box, and that box was sold to Fannie Mae and Freddie Mac. With the advent of the non-QM loan, those loans that are particularly more competitive, you also have to see rates rise, which they've done, to give the opportunity to a private mortgage sector to come back in and start funding these loans. Well, I read a statistic the other day that said that 40% of loans in 2019 will be non-QM. Now, we have about $1.5 trillion in loans that we're going to have out next year. $1.5 trillion. Wrap your head around that. 40% of that means that you've probably got $450 billion worth of loans or higher that are going to be non-QM loans. That's a big number, which means that the private money back into the mortgage space is a good thing. Now, we have rising values in homes, which is obviously why the rates are also rising, try to slow that down. Plus, the economy is good, which is another reason to raise rates, to try to cool that off a little bit. But all this means that competition with Freddie and Fannie has begun with non-QM loans. Now, is this the same as what we used to have, we used to call subprime? No. The borrower may look similar, but credit scores are going to probably average above 700 on non-QM loans. And in those non-QM loans where credit scores aren't even considered, you're going to have at least 25 to 30% equity in the property. Now, that never happened before. When we used to do stated income, stated asset loans, or no income, no asset loans, you would have signature loans. You wouldn't have any skin in the game, they used to call it. Well, you do today. And the skin in the game is the 25 to 30%. And in an ascending market, those loans look very attractive, which is why the growth in the non-QM sector, and 40% of loans next year is going to be a big number. That's why you're seeing this, because, look, hedge funds, Wall Street, sovereign funds, insurance companies, they all want to get into the mortgage-backed security game, because when you're buying pools of loans to the tune of $1 billion to $5 billion at a clip, at 3 to 4 to 5% per year, that's a pretty good return. Treasuries are only returning 2.5 to 3%, so this is a better return on your money. Anyway, I'm Jeff Barton. Really happy you tuned into the show today. I hope you learned something. I certainly appreciate you listening. I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.